In the next few minutes, we'll show how power, uncertainty, and disagreement inside the Federal Reserve shaped markets in 2025, and why those same divisions will drive decisions in 2026. The year 2025 marked one of the most visibly divided periods in the Federal Reserve's recent history. What unfolded behind closed doors was not a simple debate over interest rates, but a deeper conflict over how to interpret an economy sending mixed and often contradictory signals. At the center of the divide was inflation. While price pressures had cooled from earlier highs, they remained stubbornly above the Fed's long-term target. Some policymakers saw this as proof that restrictive policy had worked and could now be eased carefully. Others warned that inflation's persistence, particularly in housing and services, meant cutting rates too soon could undo hard-won progress. At the same time, the labor market added to the confusion. Job growth slowed but did not collapse. Unemployment edged higher but stayed historically low. For one group at the Fed, these signs pointed to an economy that needed relief before damage became permanent. For another, the labor market still looked too strong to justify faster rate cuts. These competing interpretations led to a Federal Reserve that began easing policy cautiously, but without unity. Rate decisions increasingly included dissenting votes. Economic projections showed wide disagreement over how many cuts would be needed next, and how long inflation risks would last. Markets noticed immediately. Investors reacted not just to what the Fed did, but to how divided it appeared. Treasury yields swung sharply. Stocks responded to subtle changes in Fed language. Each meeting became a test of whether the central bank was leaning toward growth protection or inflation control. As 2026 approaches, these divisions are not fading, they are carrying forward. Inflation is expected to cool further, but no one agrees on how quickly. Economic growth could stabilize or weaken, depending on how past rate hikes continue to filter through the system. Each possible outcome supports a different policy response, keeping the Fed internally split. Changes in voting members and leadership dynamics will further complicate the picture. New voices may shift the balance between caution and accommodation, making consensus even harder to achieve. Meanwhile, fiscal policy and political uncertainty add pressure, with some officials worried government actions could reignite inflation. The Fed's own projections for 2026 reflect this uncertainty. While the median forecast points to limited rate cuts, the wide range of expectations reveals how deeply policymakers disagree about the road ahead. Every dot tells a different story of risk, timing, and tolerance for economic slowdown. For businesses, consumers, and global markets, a divided Fed means less predictability. Borrowing costs may fluctuate, investment decisions become more difficult, and volatility remains a constant presence. The world is adjusting to a central bank that is cautious, data-dependent, and openly divided. In the end, the divisions that define 2025 are not going away. They are shaping a Federal Reserve navigating one of the most delicate balancing acts in decades. As 2026 unfolds, policy will be driven not by certainty, but by debate and by the ongoing struggle to choose between inflation risk and economic slowdown.